My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold...
Do these stocks have names?
Warren Buffett, the billionaire investor, will go down as one of the greatest investors of all time. If you had given Warren Buffett $1,000 57 years ago, it would have been about $36 million. That's over 3.6 million % return. Warren Buffett began investing at a very young age of 11 years old. Though starting early played a very important role in his success, there are key principles and strategies that has contributed to his success. We as small investors could emulate some of these principles and strategies to help in our investing journey. In this video, I'll share clips of Warren explaining the reasons why small investors can experience much faster growth. Then I'll make a summary about it.
I'm Michael Zenga from Danvers, Massachusetts. That's a town whose band Mr. Buffett so generously sent to the Rose Bowl parade last year, so you're a very popular guy in my town. Good morning, Mr. Buffett and Mr. Munger. Mr. Buffett, I wanted to ask you this question last week when I ran into you after Gillette's annual meeting, but I choked. So now there's no pressure, here goes. In the years, from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued, excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses that where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny amount of money, and so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap, and obviously as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Hello. My name is Howard Love. I'm from San Francisco. Thank you very much for this weekend in general and this meeting in particular. Recently at a talk at the Wharton Business School, Mr. Buffett, you indicated that you were talking about the problems of compounding large size, which I appreciate and understand. But you indicated, you're quoted in the local paper as saying that you are confident that if you were working with a sum closer to $1 million, that you could compound that at a 50% rate. For those of us who aren't saddled with the $100 billion problem, could you talk about what types of investments you'd be looking at and where in today's market you think significant inefficiencies exist? Thank you.
Yeah, I think I may have been very slightly misquoted, but I certainly said something to the effect that working. I think I talked about this group I get together every 2 years and how I poll that group as to what they think they could compound money at it with 100,000, a million, 100 million, a billion, and other types of sums. And I pointed out how this group of 60 or so people that I get together with every couple of years, how their expectations of return would go very rapidly down this slope. It is true. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation. If they needed it, I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money 100 million or a billion at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith's interview a few years ago, if you start with A and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you can, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds. Because from $1 million to 10 million, I would say it would fall off dramatically in terms of the, because there are little, you find very, very small things that you can make, and you're almost certain to make high returns on, but you don't find very big things that in that category today. I'll leave to you the fun of finding them yourselves. I mean, it'd be terrible to spoil the treasure hunt. And the truth is, I don't look for them anymore. Every now and then I'll stumble into something just by accident, but I'm not in the business of looking for that. I'm looking for things that Berkshire can put its money in, and that rules out all of that sort of thing. Charlie?
Hi, I'm Howard Winston from Cincinnati, Ohio. First, I wanted to thank you and Charlie for sharing your time with us today.
Thank you.
My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold...
Do these stocks have names?
Well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, I've got this wonderful thing, and I usually know ahead of time, but I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and you could, and you know, it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then.
So quite a few things were said in those videos. But there are 4 main reasons why it's much easier to grow a smaller account than a bigger one. Reason number 1 is you can sell more frequently once you see your stocks reach its fair value. So you don't have to really wait. Like if you have a big position or you have a big amount of cash and you cannot find enough stocks to really make a meaningful impact on your portfolio, you can sell more frequently and look for more undervalued stocks. Reason number 2 is you have a larger universe of stocks to choose from. So when you look at institutional buyers and pension funds, they are working with a certain amount of money. So certain positions won't really make a meaningful impact on their portfolio. And also, another thing is that the media doesn't cover a lot of the small cap companies, so that create opportunity for small investors to find wrinkles in the market and more opportunity. Reason number 3 is you can be more concentrated and less diversified. So in that way, you know, in some instances you're able to get a bigger gain on some positions, and that can push your portfolio much higher. But you must know what you're doing when you're going to go this route. And reason number 4 is that the competition amongst institutional buyers and large funds, it's much higher once you go up, because those funds are looking for ways how to generate more returns, and they cannot get it from the small companies and the small cap stocks. So it's going to create more competition. So as retail investors that have smaller accounts, we have more opportunity to grow our accounts much faster. If it's your first time on my channel, please like this video and subscribe, and stay tuned for more videos. Drop in the comment section any topic you want me to discuss about.